Lukman, thanks so much for your time. I mean, we are seeing panic selling across the board when it comes to what global stock markets are doing. What's your in-house view on this coronavirus and just how big of a risk it is for markets right now?
The coronavirus has the world on high alert. We have I feel this sense of uncertainty as investors try to access the human and economic cost of what the virus means for China, Asia, and the global economy as a whole. When we look at the virus may result in tourism taking a hit, retailers feeling the pinch and transportation dropping. So ultimately, if the virus results in slow growth in China, when China sneezes, everyone else will catch a cold. And this sentiment is being reflected across global stocks. If you look at Asia, Europe, and American stocks, they're all flashing red. I think it's too early to really gauge how deep or how much it will impact the markets. But what I can say is, if the cases or if it continues to spread across Asia and throughout the world, it should continue promoting risk aversion, ultimately hitting global stocks.
Because, I mean, we are feeling quite a lot of pain here in South Africa with the rand also coming under quite a significant pressure. Is this all down to the fears of the potential of a spread of this virus, or are there other sentiment drivers here?
You can say the rand has woken up on the wrong side of the bed today. I looked at it earlier; it was over 1%. It's lost over 1% against the dollar, and it's weakened against every single G10 currency. I think there's two things really hitting the rand right now. The first is the general risk aversion that we're seeing, that is reducing appetite for emerging market currencies, and the second is the fact that South Africa and China have a close trade relationship. So if the coronavirus ends up negatively impacting the Chinese economy, this could result in less demand for South African products and ultimately hit the South African economy. So these are two things that are hitting the rand right now.
I mean, we are seeing a lot of money moving out of stocks and going into, safer plays like gold. And I'm just wondering if this is also the view that you are taking in terms of protecting any form of returns here.
You know what they say, uncertainty is the enemy of investment, and this is the theme we're seeing across markets. When we have virus fears or there's the threat that slowing global growth could come back to the forefront, nobody really wants to have any safe or close distance to risky assets. So we're seeing gold push higher. I believe gold could trade towards 1,600 in the short to medium term this month if uncertainty remains a key theme. Let's not also forget about the Japanese yen and the dollar, which are still seen as prime destinations of safety.
And then on the other side of that argument, we are seeing the oil price take a significant beating itself. What are your projections for where the price is headed, which currently now sitting below that $60 per barrel mark?
Oil markets are certainly not looking pretty at all. I mean, just today, oil prices have declined over 3%. And since the start of the year, both WTI crude and Brent have lost over 10%. So this is quite significant. So the breakdown is that the fact that we know that China is the largest energy consumer. So if the coronavirus results in strong global growth in China, this could result in a drop in demand for crude oil. As things stand right now, I think the path of least resistance for WTI crude and Brent point south, and we could expect oil prices to trade far below the 62 and 53 levels on WTI crude and Brent in the week ahead.
I mean, of course, Lukman, shifting focus away from the coronavirus right now. This week also quite a big week for London in terms of that Brexit deadline approaching. Come the 31st of January, if you had to look into your crystal ball, what happens?
I mean, Fifi, it's been almost 4 years since the vote to leave the European Union. So even now the Brexit is just around the corner. I think it may come as a relief in the sense that all the back and forth and drama is going to come to an end. But what I can say is you should grab your popcorn and prepare for another ride because the next 11 months are going to be very rocky for the British pound. On Friday, we can see a limited market reaction because I think this has already been priced in. It's what happens after Friday. It's what's going to determine where the British pound is going to trade. I can see further uncertainty, more drama, and if it looks like the UK is going to leave the European Union by the end of the year with no Brexit deal and revert back to WTI rules, this will be negative for the British pound.
Risk negative for the British pound. I mean, talk us through your forecasts in terms of where and how negative it could be. Just what levels are we looking here in terms of significant weakness, and over what time frame?
So if you look at the pound against the dollar, it's been trading within a wide range, support around 1.30 and resistance 1.315. But now, if it does look like the UK is going to leave the European Union at the end of 2020 with no post-Brexit deal, the British pound could actually sink towards 128 and 1260 over that period of time. But there's another thing that we have to keep in mind that will influence the pound, and it's the monetary policy. So as you know, this Thursday, the Bank of England meet, and it's a 50% probability that they're going to cut interest rates. But if it does look like the Bank of England is going to cut interest rates in the effort to support growth in the UK, this is another thing that's going to push the British pound lower against the dollar and other G10 currencies.
Well, quite an eventful week there for the UK. This week we'll be watching closely. Lukman, thanks so much for your time. That was Lukman Otunuga, who is a senior research analyst at FTXM.